Hey everyone, welcome back to another episode of Small Business Stories. You know me, your host, Dr. LL, Loralyn Mears here of Steeris, and every week bringing you all kinds of solutions from, I don't know, marketing to legal to AI to, here's an interesting one. On that finance end, we've got Daniel McDavid. He is the founder of Move Mountains Credit Repair. His company is wholly focused on helping individuals rebuild their credit, right? And then restore that financial confidence and create a path towards longer term financial stability. Let's welcome him to the show. Hi, Daniel.
Hello there. Thank you for having me.
Well, let's kind of set the stage here. So, I know some of the recent data coming in from Small Business Association is that more than three-quarters of small businesses in the US are currently operating on loans. And we know that there's a lot of hard luck loans out there in addition to the ones that Small Business Association is reporting. So it sounds like that there are some problems with folks that are having the opportunity to maybe not be able to pay back what they've borrowed. What's going on out there in the world in your land? You see everything from the credit repair side. What's happening?
So I would say a lot of times when people go into business and they're taking loans, a lot of times they're not looking for something called phantom expenses. So a phantom expense is when an expense shows up that you are not expecting. It just showed up out of nowhere, whether it's your inventory or maybe something goes wrong or maybe you've been, trying to find someone for a role and you've put a lot of resources into that, and then they end up, deciding to leave. That right there can be an unexpected expense that is now pulling from the money that the business owner already had. So I would say a lot of times business owners are just not planning for these unexpected turns in their business.
I want to pull on that a little bit because I've had a number of folks on here who provide financial paths forward, being different kinds of loans, different structure, financial planning, and advice. And one of the things that we've heard consistently from those guests is that if you, as a business owner, are in trouble, financial trouble, like you've got OpEx payroll issues, and so you are desperate to get that money, you are not going to get favorable terms for your loan. And many people get forced into these hard luck loan situations where the terms can be egregious, 40% interest and things like this. So, how do people do a better job planning so they don't get stuck in that situation and then have to come to folks like yourself and say, oh my goodness, my credit has been shot. Now what do I do? How do they prevent that?
Well, the best way really is to plan. It depends on, of course, how long the business has been running. If the business is brand new, then of course they're not going to know what to expect going into it. But if they've been around, then they're going to have somewhat of an idea of how their industry works. Like, if there's high months, low months. But I know what you're talking about. You're talking about something called revenue-based funding. So there's different types of funding. There's like three main ones. The one that I usually recommend to my clients is called PG, personal guarantee. So that's pretty much where you get your credit repaired, and then you're going to be able to qualify for business funding. But the business funding is going to be on a business credit card, and usually it's 0% interest for 12 months. That's the one I myself got started on. Because, like I said, I had to improve my credit, and then I had some friends who had resources that were able to get me started. But personal guarantee, that's the number one recommendation that I give to the clients that I'm working with. But if a business has already had business funding, then what they can do is they can use their business credit to get even more business funding. But you can only do that after you have a business and you have business funding. So that's the second type. That one's called, no PG. That right there is just your business. And then the third type, the one you just mentioned, you said where there's like hard luck loans. That's called revenue-based funding. And what that is there are different lenders who will give people money at extreme terms. And they're doing that because it's not based off of their credit. And what it's usually based off of is how much money you've had in your bank account for the past, usually 4 to 6 months. And they usually want to see like 14,000. and above. And then after they see that consistently in your bank account, then they'll usually go on ahead and potentially approve you. But when they do, they'll usually make it where you either have to pay money daily, or you have to pay money weekly, or you have to pay money monthly, which that makes it a lot harder compared to having a whole year to figure out whatever you're doing, and then you have to start paying it with the PG. But what I would say is that revenue-based funding, I've seen for some people it works, for other people it doesn't work. And what I mean by that is, um, let's say a business like, hypothetically speaking, Netflix, right? Let's say Netflix is in a really tough bind in this one particular month for who knows why, whatever reason, right? Maybe something unexpected happened in the market, and now people are turning to different places to watch movies and shows. And let's say for 1 month they temporarily go down, so they decide to take out revenue-based funding at some really bad rates, like let's say 15% or 16%, right? Um, when they get that money and they pay their bills and do whatever they have to do to keep the business going, in the next month, of course, they're expecting the money that they had in the previous months to start coming again. So when they get that money in the next month, they're going to successfully be able to pay that money back, and there's not a problem. There's some cases like that, but and then there's other cases where a business owner will expect that their business is gonna maybe catch back up in the next month or catch back up in the next couple of months, but and then it doesn't. And then when it doesn't, that's when they're stuck in this really difficult position, wondering what they should do from there. So I would say, when it comes to planning, my recommendation would be to just not take that loan at all, which I know, I mean, it sounds easier said than done when you're not in a position where you really need it. But, I always encourage people to work on their credit, get their credit where it needs to be, which is usually above 680 with no negatives on your credit profile, no late payments. Um, and having usually, if you want to qualify for the personal guarantee business funding, you have to have a credit card of at least $2,500. And after you have some of these qualifications, then you'll qualify for, like I said, the PG, where you have a year to try to figure things out. So if I was going to talk about a plan or preventative measures, I would say that would be the route to go.
Okay. Now, in our audience, that's valuable information. So I want to just emphasize some of it. Our audience ranges from solopreneurs who are thinking about starting businesses to CEOs who have businesses that are generating hundreds of millions of dollars per year, right? And everything in between. One of the things that you said about the business credit card, I've had so many different folks that I've talked to over time that are starting businesses that think, well, I'm not going to get a business credit card. I'm just going to use my personal credit card and whatever. Talk to them about what they're losing with respect to the opportunity to build business credit, and talk to them about the risks where they're commingling personal and business funds. Talk to us about this, Daniel.
So the risk is that at the end of the year, when it comes to taxes, they may not recognize that, all the expenses and things that you've been doing, which could potentially lead to an audit. Or in some cases, if somebody was to sue you, this is usually one of the biggest risks. If someone was to sue you and you're not having your money separate, separate at that time, what they'll do is they'll do something called piercing the veil. And piercing the veil is pretty much where they go through your LLC and they are attacking your personal finances. But usually the purpose of an LLC is to provide protection, where if anyone sues your LLC, it doesn't affect you personally. So you can still live your life and you won't go broke personally. But if you are not following the rules or the laws as far as separating your expenses, then when it's time for you to potentially be sued, hopefully you don't. But if you were, then they're not going to recognize you as a legitimate LLC, and they'll just pierce that veil, and then they'll take your personal money. So that's the risk on why you do want to separate your finances. And then, of course, when it comes to taxes, of course, you want to avoid audits. You don't want to trigger any red flags and have any of that. That's just a lot of work and energy and money that's needless. And then when it comes to the benefits, so I would say a benefit is, hmm, if you use a resource like QuickBooks, or Intuit, there's other what's that called, resources that a person can use when they're trying to keep track of their expenses. What it does is at the end of the year, it's not so difficult when you're trying to file your taxes. That's really easy. And then on top of that, you can take, legally within the law, you can take deductions as a business owner, which can, lower the amount of income you made in a year. And if you have a W-2, what that can do is that could potentially make it where the IRS will end up giving you some money back. It's usually just the money that you paid throughout your time at your job, but that can be very useful when you're doing a business and a W-2. But usually, as a business owner, if that's your main source of income, the goal is to not have to pay anything because you got all your money during that year and now you just don't want to pay anything. That's usually the goal. But those benefits, they're usually easily accessed when you're following, like I said, the rules and you're keeping your money separate. And it just makes things clear. It makes things simple. You don't want to be guessing like, man, like, was this a business expense or was this personal? Like it just makes it very difficult. So that's what I would say about that.
Okay, excellent advice there. Now, I want to just refocus the conversation a little bit, talking about credit as a reflection of behavior. A lot of people think, oh, whatever your credit score is, okay, that's a number. And I've seen so many people say, well, if your credit number is this and it's low, it's below 680, it's below 500, my goodness, you're in the 400s. People look down on that and think, ooh, shame, you've got bad habits, bad decision patterns. Is it really about that behavior, or do people get into difficult situations with their credit scores because of other reasons from just bad behaviors and bad decisions? Talk to us about the psychology behind this.
Well, I'd say it can go both ways. Of course, it's a person by person basis. Not everyone is the same, but normally what I've seen is that there's usually two types of people. One type of person, they had something bad happen to them. They're responsible, they've been on top of their stuff, and maybe, an accident happened or a funeral or there's something very unexpected happened that really took them out of their rhythm and, they weren't able to catch up, maybe because of medical bills or um, maybe they got hurt and then they couldn't keep up with rent or keep up with different things. And then, of course, right now there's a very extreme scenario with TSA where they're not getting their money because of government political reasons, which is that's another unexpected reason. I'm sure they weren't expecting working for the government that they weren't going to get any money. But again, sometimes there's people who are just in very unexpected situations, and that those are the people that will need their credit repaired. Um, but like I said, I would say for the most part, the people that I come across outside of people who are in tough spots like that are individuals who, like you said, they don't really have the best habits. Maybe they didn't learn it, and maybe they haven't taken the time to try to learn it. But um, another thing that you mentioned too, the credit score, it's not just about the credit score. So the credit score is pretty much the accumulation. It's the overall number based off of your credit profile. So let's say we were talking about grades, right? It's kind of like grade school where let's say you're in a class and you have an A, and then now your score it says you're at 100%. But and then now you're in that class, and one day maybe I don't want to say the dog ate your homework, but something unexpected happened, and you ended up getting an F, right? So, anyways, you got an F, and now that you've gotten an F, that 100% you had is now going to go to like a B plus. You're probably thinking to yourself like how I'm getting all these A's. I just missed one time, but now I'm at a B plus. I should still be at an A. But the reason that it doesn't work out like that is because of ratios and because of how low that score was, or how bad that grade was in the entirety of your overall score. And it's just like that on your credit. There's a lot of people who will continually get A's, and let's just say that the A's are positive accounts, right? You're consistently getting positive accounts. You're consistently trying to do everything that you can, but you have a collection, and that collection is like an F, or even worse, you have a bankruptcy, or let's say you have a charge off, or you have people don't know this. One of the worst things you can have on your credit is a late payment. If people think like, oh, I just have a late payment from a long time ago, it's not that big of a deal. It's a very big deal because that's actually the main way that credit is calculated through payments. It's 35%. And what that means is if just one late payment can cause you to lose up to 192 points. Usually it's between 50 to 100, but again, that's still a big chunk of your credit that's getting affected by just one late payment. So a lot of times people don't know that. But in a nutshell, what we do when people come to us and they work with us is we're able to get rid of the F that was on your grades, right? On your overall score. And obviously what that does is that's going to make your score go up because like I said, negatives never help you, but it's all based off of the person's credit profile. So like I said, us getting a collection off or a bankruptcy off, that's going to really assist them when they're trying to build up their credit. But a lot of times people get it backwards. They start trying to build while there's still negatives there. But even though you're building, you might go up 1 point, or 0.5 points. It's like that's not even worth it at that point. And even though they're trying really hard, they feel like they just can't get ahead. And that's because they don't understand how big of an effect that negative is. That's what's stopping them. That's what's holding them back. But once that negative is gone, now all the work that they've been doing, now all the building that they've been working on will actually start to show. Now they'll be at 100%, or they'll be in the 700s, or the high 700s. That's how that works.
Got it. I didn't know that a late payment just takes you that far down, that it can be that big of a whack. I can't sit up here and say, I've never had a late payment. I have perfect credit. No, no, I have been one of those, busy ADHD entrepreneurs, right? Little squirrel, like, what? Oh my God, that was due last week. What? Right? Yeah, it has happened for sure. You talked about big effect and big impact. I want to talk about the emotional experience inside of things. So when your clients come to you, right, to move mountain, credit repair, talk to us about the emotional state of the heaviness of what's happened now because they've got poor credit. Because we all talk about the legal, the financial, these are the terms, these are this, the paybacks, the consequences if you don't. But what about the emotional stuff? I think that really factors in here.
Well, I would say a lot of times when people um, do decide to work on their credit, for the most part, usually an emotional choice. They're thinking about how the last time they got denied, or because something bad happened, now they're choosing to do it. But I do wish that people would kind of be more logical about it. There's some people who are very logical about it. They're like, oh, I'm not trying to get a house or a car. I just want my credit to be better, and this is the smartest way to do it. And then they work with us, which is great. But and then, like I said, what you just said a second ago for the emotional aspect, to be honest with you, usually people come to us and they share how they've been trying to get their credit repaired for a long time, but they went to this company and they got scammed, or they went to that company and it didn't work out. And a lot of times they'll be just very defensive, and it's weird. It's almost like they want help, but they're not sure if they should even try anymore. So I would say
Mm.
that's the emotional state. It's almost like they've kind of given up, but they're just hoping for something, and they're hoping that our company can be that something for them. And usually for the people that do work with us, we're able to help them get to where they're trying to get to. But as far as an emotional state, like you said, I usually say that they're not happy campers.
No,
Yeah.
I would think. And then you said something there that's that's really key is that there are so many of these businesses out there. Oh, we promise we'll fix your credit, we'll consolidate your debt, we'll do this, especially at the 2 o'clock in the morning infomercials for anybody that's up at that hour and listening, podcasts, anything. Those tend to be the ads. And so, what's the difference between helping people with like the short-term fix, right, to start to repair their credit versus actually helping them build a sustainable financial foundation? Talk to us about that difference.
Definitely. Well, the main thing is it's them, like it's their mindset. Like it's so interesting. A lot of times they think, oh, once I get my credit repaired, everything is going to be fixed. No, that's not really the solution. The solution is you have to transform. You have to become someone that's actually on top of your stuff. You have to become someone who's actually paying attention to different bills and things you have going on. Because if you don't, you're just going to end up here again. And it's not like I'm not going to want to work with you and, of course, take your money and help you. But it's like, that's not really the goal. I'm not
Right.
really just trying to take people's money. The goal is for the person to actually recognize that, yes, they did make some mistakes, and that it's okay that they made a mistake. There's something that can help them. I think credit repair is kind of miraculous that you can get 100% again, and everyone will think that they won't be able to judge you based off of your past. You'll be able to move forward with your future after getting your credit repaired. But I do think that it's more important that, like I said, the person learns these skills. And you said the rebuilding process. I would say the first step is patience. You got to
Mm.
be really patient. A lot of times people think like, oh, okay, well, yeah, I know my credit is messed up, but like it shouldn't be taking this long. I should be in the 700s by now. And it's like, well, listen, if you have spent 20 years eating junk food and you go to a doctor and you say, hey, doctor, I need you to make me healthy and skinny by tomorrow. The doctor is going to tell you, like, as much as I would like to do that, that's just not how this works. And it's just like that with credit. There's a process to it, right? We have to communicate with the bureaus. The bureaus have to respond. A lot of times they have to investigate and do different things. And because of that, that usually makes the process between 4 to 6 months. And it could potentially take 5 to 8 months if a person has a bankruptcy. But if you look at it in perspective, 5 to 8 months compared to 11 years is not that long. And then on top of that, if you're looking at a collection for it to come off normally is 7 years. So what are you going to do? I mean, are you going to just wait for 7 years until it falls off, or are you going to work with the company that could potentially get that off within 4 to 6 months? It's really a no-brainer. But like I said, a lot of times people are being emotional when it comes to trying to work on their credit, and they're not thinking logically. So the way that would look like is, after 4 to 6 months of them getting their credit repaired, um, it all depends on how many positive accounts they have after their credit is repaired. But if they don't have very many positive accounts left, because usually what happens is a positive account becomes a negative account that me and my team now have to get off of their credit. So after that's taken off of their credit, now they have to start getting positive accounts. And that's what the rebuilding really is. The rebuilding is, I need to get maybe an auto loan, potentially, if that's what you need. Don't want you to just get a car for no reason. But maybe instead of an auto loan, maybe a credit card, or have you been keeping up with your mortgage payments? Or if you do have an installment loan, are you keeping up with that installment loan? And then there's different, resources, apps, and different things that can help build a person's credit up. But that's what the rebuilding process would look like. Which who knows, that could take, maybe I would say another 3 to 5 months, depending on what they're working on. But in a nutshell, the reason credit takes a while is because time is connected to it. Anything time is connected to something is not going to be like a 1, 2, 3 ABC type of fix. It's going to require some energy and effort. So in a nutshell, that's usually what it looks like.
Okay, earlier in your answer, you used the T word, Daniel, trust, right? There's a lot of skepticism out there. And so trust, I think, can be really fragile. What do you do as a business owner to build credibility with clients who we said like are already feeling burned, they're skeptical, they've just about lost all hope and they're just praying for some kind of miracle? How do you build trust with them?
Well, I tell them the truth. I let them know, like, hey, it did not take you a couple of days to get here, and it's not necessarily going to take you a couple of days to get out of here. But what I can say is that if you do nothing, you're going to stay here longer than you would like to, for sure. So I just tell them the truth and let them know it's going to take about 4 to 6 months. Could take a little bit longer. It really depends on the bureaus and really how much they have on their credit. So I let them know that, and then I also let them know that legally speaking, no credit repair company can guarantee a time frame on when the negatives are going to be removed off of your credit. If any credit repair company is guaranteeing results, you should be worried, because not only have they just broken the law by saying that, but that usually means that they don't really have any intention on fixing your credit. Because if they're guaranteeing that, that means they're telling you what you want to hear, because they want to get your money. And then after they get your money, they're going to just disappear. And it doesn't matter, because they don't have to worry about actually fulfilling what they said. But for us, we're actually going to fulfill what we say. So I'm going to tell a person what they don't want to hear. I'm going to tell them the truth. And even if it hurts. And This is the reality that they need to face, right? Kind of like if a student is in school and their grades are not good, as a teacher, you're not going to just uh, pass them on through and tell them, oh, everything is all right. No, you're going to be real with them and let them know, like, hey, if your dream really is to be, let's say, a doctor, then you're going to have to know anatomy. You're going to have to know some of these different things, and you're going to have to give it your all. And you can't just, slide by. You got to really put in the effort here. And in like manner, that's usually what I like to do. Uh, just tell them the truth, nothing more or nothing less.
Yeah, that's the way to do it, right? I mean, that's how you build credibility. It's how you build long-term relationships. Truth, honesty. Oh my goodness, imagine that, right? On a personal or professional level. It's exactly it. Bingo, bingo. Now, I'm curious, what's the weirdest, wonkiest, again, we never want names, we never want any of that. We don't tell tales, but thing that has come across your desk at Move Mountains Credit Repair?
Do you mean in terms of like how much they had on their credit, or in terms of how they were acting or being as a customer?
Any of it without something that's going to be exposing of who that customer is. I'm just saying, like, you must see a lot of cases, like just crazy things. I saw a TikTok not too long ago, and this was this young man. He lives in his parents' basement. He has no income, and he's $200,000 in debt buying designer clothes.
Wow. Yeah, that is pretty crazy. But you know, something that I have found very crazy. I mean, every single time it happens, my mind is just blown. But I always have to remember, and I try to put myself in the person's shoes and see. I try to see it from their perspective. But I had a person that I was working with. This gentleman had a couple of bankruptcies. He had over 100 hard inquiries. He had more than 30 collections. And in a nutshell, he was pressing me and my team, saying like, "Man, credit repair doesn't take this long. I should have been done last month." And I'm thinking like, "Sir, it's only been 2 months. Like, don't you remember? I said this is a 4 to 6 month process, and then on top of that, you have a bankruptcy." But again, what I would say that I find to be the craziest thing is how much people don't understand their predicament. I'm just thinking like, sir, not only do you owe a lot of money, but like you're never gonna be able to get approved for anything again ever if this stuff doesn't get taken off of your credit correctly, the right way. Because there's a right way to do credit repair, and then there's an illegal way to do credit repair. The illegal way, you can get stuff removed off a person's credit really quickly, but and then what happens is it ends up coming back onto their credit, which of course our company does not operate like that. We only operate within the law, and we do things according to how it's supposed to be. And this is what I was letting him know. I was letting him know, like, sure, we just follow the law, and as the time frames are going to be the time frames. There's no way that we can expedite it. That's not how this works. And I'm just always shocked because I'm just like, wow, like how do you not know? Like you are in a very, very terrible position right now. But it's weird. They almost make it seem like it's the other way around. Like they're doing us a solid, and it's like, okay, okay, sir, all right. So I
Yeah,
would just say the pride. Pride is something that always astonishes me. It really does.
yeah. Pride, ego, right? All that stuff. Like we've all seen it. It's like, whoa. Okay. So, Daniel, as we're wrapping up our show here, how and where can people find you?
Yes. So they can find me online. I have a website. It's called movemountains.funding.com. And then another place they can find me is on Instagram at Daniel McDavid1. And then if they wanted to reach out to me directly, they could shoot me a message. They could just message credit at 949 208 7175.
Okay, perfect. We're going to want to make sure we get all of that in the show notes and captured. All right, last question. It is our signature question. If we got a chance to peek into your closet and looked at the footwear in your closet, what are we looking at? Sneakers, boots, something that says, I am Daniel McDavid. This is so me. It personifies who you are. What are we looking at?
You'd be looking at QCs and Hokas. That's what you'll be looking at.
And why?
Well, um, I usually like to go for walks and trying to lose more weight. And I honestly just think that QCs are I believe they're called on clouds, but sometimes people call them QCs. But they're very comfortable. The most comfortable shoe that I have ever had. So yeah, and then Hoka's they're really good too, but I would say they're like a close second. I think on clouds are way better. Yeah.
Okay, there we go. Right. No endorsements there, but but it's all good. And the funny thing is most of our founders that are on our show answer something around some kind of sneaker, something, keep people moving because we're all like entrepreneurs, we're in motion, we're hustling, we're trying to make stuff done, we're making an impact, right? We're trying to change the world. So with that, our show is a wrap. Daniel McDavid, founder of Move Mountains Credit Repair. Thank you so much for being on our show and doing what you do to help give people a second chance, right? Fix that credit so they can do the things they want to do.
Thank you.